Greetings, everyone. We are back with another monthly market commentary video. I'm going to share some slides along with my observations about the current market action. No shortage of content and things going on with all the geopolitical things. We have the Fed, we still have inflation. We're going to touch them all. I hope you enjoy this. I have no script. I'm not reading anything. I'm going ad lib. So I hope you enjoy it. It's going to be graph heavy. With some of my commentary and thoughts, and give you a sense of what we're thinking, kind of the inner workings of how we approach all the different flows of information coming at us. And I hope you learned something and can apply this to your personal portfolio or better understand how we think at Pure Portfolios. So with that, I'm going to stop talking and share my screen. I hope you all can see that. Okay. And we're going to be doing more of this. So at the end or the start of every month, I'm going to be doing this. So give us feedback. Let us know what you like, what you don't like. I'm in my bat cave in Camas, and the lighting's kind of tricky. So feel free to give me feedback on that as well. So enough of that. Let's get into the good stuff. So this is asset class returns since the Russian invasion, and that happened last Thursday, the 24th. Now, this is fascinating to me, where you see at the open on 224, the S&P, the Nasdaq, this ARK ETF, which is kind of a basket of risky tech names, on down to bonds, gold, and Bitcoin. You can see how there was a flight to safety, a flight to oil. You see gold went up, bond prices went up, the yield went down. So you see this negative 15 basis points on the 10-year yield. That means people were buying bonds. So there was a flight to safety. There was a seeking out of US dollar denominated assets, which is not uncommon during a geopolitical event. What threw people for a loop since the Russian invasion, since the open of the Russian invasion? Look at the change in stock prices. The S&P up almost 7%. Nasdaq up 8.5%. That risky ARK fund up almost 18%. Oil is actually down from its all-time highs. Bond yields are slightly up. Gold sold off a bit, and Bitcoin has skyrocketed. This is just fascinating on so many levels. One, I go back and look at the 2021 market forecasts that were published at the end of last year for 2022. Virtually no one had Russia, Ukraine at the top of the list. Okay. And even if you did, even if you had that at the top of the list, the market often doesn't act the way you think it should. It doesn't act the way humans think. War starts, that's bad. Market prices should go down. Doesn't work that way. This is another example of that. The COVID crisis was another example of that, where stock prices sold off, they bounced back almost just as quick, and none of it really made sense. So just because you can predict the outcome of an election or predict that a war is coming, stock prices are going to act in a way to make the most number of people look stupid. That's just the way it is. So this is one of my favorite graphs for context, right? People are understandably nervous, but this is just really good for context, where you can see where we were coming up to the pre-COVID high, November of 19. COVID happened, we cratered. You see the COVID crash low, negative 48%, that kind of burnt orange line. And then the snapback, and you can argue the snapback right here, like this highlighted yellow line, none of this really made sense. I mean, if I'm being honest, this move higher, this explosion higher, didn't really make sense. And that's fine. It doesn't have to make sense per my previous comments. But to be here and to sell off roughly 9.5%, again, this is the S&P. I mean, if you're being honest, investors have to feel pretty good given all that's going on with supply chains and inflation and COVID still and the war now and energy crisis. So this is a standard correction. On average, the S&P sees one of these every 2 years. If we get another 12% down from here, that would be a bear market. So that's roughly 20%. Academics say that's a bear market, so we'll call it a bear market. But you can see, even if we get that, I mean, we're still well above the pre-COVID high. So investors, all in all, despite the recent noise, should feel pretty good. Context provides that perspective, which I think is important. I'm going to be looking for my mouse quite often today because my actual mouse is broken and I'm working off the keypad on the old laptop. If anyone has ever done that, it is a trip. So going to just kind of a macro look at various asset classes, both domestically and abroad. A few things stick out to me here. One, U.S. stocks, U.S. large cap stocks. And by the way, this is as of last Friday. So if you're looking at this and saying, Nick, this is not accurate, as of last Friday's close. Today's Monday. I'm filming this on Monday, February 28th, in case you're curious. So the pain has really been in U.S. tech stocks, growth names. What's really worked has fallen pretty hard. What's been out of favor, so international stocks, really has started to hang in there on a relative basis, except Russia. You see Russian assets are getting absolutely pummeled. But even emerging markets, as of last Friday close, was down only 3% compared to the S&P, down about 8%. And then the international stock benchmark down about 5% versus the S&P of 8%. So relatively, what's been beaten down starting to perform better. That's great. You want to see that rotation. And then, the value factor, the dividend factor has also been back in vogue. So if you can see my mouse here, value on large cap and small cap, you see the dividend factor actually positive. So there's been very few places to hide this year. And I think that is why people feel so bad. Usually bonds carry the day. They're positive when stocks are down. That's been the historical interaction. That hasn't happened with the Fed raising rates. And then if some of you caught my blog from this past week, people feel worse now than they did during the apex of the COVID sell-off because tech, especially the high-flying COVID kind of work from home themes, have really taken the brunt of it. And investor performance, when you look at individual performance, is often much, much worse than these broader index numbers here. And we'll get to that a little bit later. And I'm going to be bouncing around here too. So this is all over the place. So this is something that we track very closely. So what you're looking at here is the S&P 500 in blue. And you see the index levels over here in the left axis, the y-axis. Okay. Red is the cost of borrowing for low quality companies. And it's actually inverted, which helps. So the S&P is going along here. We had the recent sell-off this year. So this means the cost of borrowing for lower quality companies, so junk companies or high yield bond companies, companies that issue high yield bonds, is this red line. And as this red line gets lower, that means the cost of borrowing goes up. So this is bad right here. And this is something that we track. And if this gap gets wider, that would be a cause for concern. So anytime this gap gets wider, you can see it happened, what is that? That might be early 2022 or late 2021. That often preempts a leg lower for stocks. And you can see that happened here, where the cost of borrowing went higher, boom, stocks dropped. You can see it back here. Cost of borrowing went higher, stocks took a little dip here. So this relationship is something that we're paying attention to, because in this country, there's a lot of lower quality companies that are highly indebted, meaning they have a lot of debt. And if you take a marginal company and you increase their cost of borrowing, their cost of capital, that business goes from viable to maybe not viable. That goes from solvent to insolvent. If you can't access the debt markets and you depend on debt to keep going, then that could be a problem. So this is something that's part of our rebalancing process, part of our monthly screens. If this gap gets wider, that would be a cause for concern for us, and we could take some additional risk off the table, meaning selling equities and rotating into less risky assets. Semiconductors. So back in the old days, and I don't want to offend anybody or age anybody, but Back in the old days, investors used to look at transportation stocks. So think railways, railroads, trucking, logistics to measure economic activity. That's kind of obsolete because we make less stuff now, but we still track semiconductors, meaning the chips that go on your phone, that go in cars, that go on your computers, that power gaming companies or gaming chips that go on your laptops. So we track the relationship between semiconductors and the S&P because this is kind of a canary in the coal mine of sorts. So here the S&P made a new low, and sorry, I'll back up. So the S&P is the blue line. So that's a theme. S&P blue. Again, this is a good chunk of 2021 and 2022. So as the semiconductor indexes go, often goes the S&P. So this is something that we want to track. So here, the S&P has bounced back. You can see lately the S&P from this bottom here has bounced back. Semiconductors have not validated this move yet. So if these are moving together, you would expect semiconductors to spike back up a bit, but it hasn't been validated yet. So that's something to keep an eye on. You know, you can see these lines move pretty good together. I mean, this could have been some, it does come unraveled sometimes, but for the most part, the correlation of these two lines is fairly tight. So what you would want to see is these lines validate each other. And right now they're kind of detached. So that's something to watch too. But again, keep in mind, the semiconductor space is really messy right now with all the supply chain issues. That's why you can't get a car. Phones are on back order. So take this with a grain of salt. I don't want to make any conclusions based on this just because of the time we're in. But this is something that we watch. Semiconductors are the new transports, and they can be a canary in a coal mine. Sentiment, many of you are probably tired of me talking about sentiment, but I love it. And this is a different spin. So last week we talked about bullish sentiment. When people are feeling really good, bullish sentiment goes up, and it's in the dumps right now. And the opposite of that is bearish sentiment. So people feeling like crap and letting that be known, that shows up in this chart. So the higher this blue line, the more crappy people feel, if I could say that. And these lines tend to be inversely correlated to the S&P. Now, what that means is as this line goes down, people are feeling less worse, and that can preclude market sell-off. So here, this is a perfect example. I highlighted this. So bearish sentiment at a low, meaning people are feeling pretty good, market takes a dive. Bearish sentiment up, meaning people are nervous and freaked out, market goes up. Only until recently have these lines kind of converged. And what I'm saying is if you did the opposite of what people felt, you would probably do pretty good as an investor. Some people are into market timing. If I was a market timer, short-term trader, I would be paying a lot of attention. I would be paying much attention to investor sentiment, both bearish and bullish. And we're not market timers. We don't condone market timing, but this is a good input to gauge human sentiment, human mood, which can move stock prices, because sometimes we forget markets are humans trading with other humans, and sometimes humans can be irrational. So I mentioned that investor individual performance is much worse than the broader indexes, and I think you can see that here. So this is kind of a snapshot of some of the pandemic darlings. Again, if you caught my post from last weekend, investors are feeling very bad right now, in my opinion, because one, they're doing much worse because they piled into pandemic darlings and getting crushed, as you can see here, and two, bonds aren't providing the buffer that they usually do. Now, the good news is bonds are starting to behave better over the last week or so, but that's a different conversation. Here, a lot of these names that people made a lot of money in have really fallen like a rock. So a lot of these names are familiar. PayPal, Block, these are kind of cryptocurrency blockchain companies, payment companies. You got an EV operator in Rivian. Oops, Rivian makes cool cars, but their stock hasn't done very well. Wayfair, my wife loves Wayfair. Zoom Video, most people are familiar with Zoom. Zillow, Pinterest, Rocket Mortgage, DraftKings is a sports betting app. I mean, look at some of these moves from their all-time high to now. I mean, just absolutely crushed. So I hope you didn't FOMO, fear of missing out, and pile into these names, because a lot of people did, and it didn't end well for them. I kind of get a kick out of some of these charts here. So this chart just reminds people, this is a good reminder, that if your position is down 50%, to get back to where you were, that position needs to double. Okay, and some of the names I just showed you were down 80% plus. You would need a 4x or 400% return to get back to your previous level. And most people don't have the patience for that. So they experience this huge down move. They're not waiting around for 400%. One, it might not happen. And two, it's much easier just to sell and admit your mistake and get out of that position. So this provides a lot of fodder for our investment approach. A lot of our clients are retired. They don't want to take a monster drawdown because they don't have the time to recoup, nor the risk capacity to recoup a major loss like this. So that's why we're hyper focused on drawdowns, on asset class correlations, how assets move in relation to each other, building portfolios that reflect the way people feel about risk and are consistent with their financial plans. Sometimes you win by not losing. A lot of energy talk these days, which I find fascinating too, because energy, this is where we're currently at, has been an awful place to be. Looking at the last 10 years, if you take this December 2021 and roll it back to the mid 2000s, if you piled money in energy stocks here, you're basically even for roughly a 16-year period. Now this excludes dividends. So if you layer in dividends, you probably made some money, but still looking at just price action, you're back to where you were back in 2006. That doesn't feel very good. But still, looking at the previous peak for energy, 77% drawdown from, call it 2014 to the bottom in 2020, early 2020. Raced 189% higher, still need another 50% to reach a new high. That's crazy. So energy, it's great now. Congratulations if you made an active bet down here on energy. But most people, if they were in energy, were in it back here somewhere and are still stuck in the mud, if you will. But this is also good too, because again, markets move in cycles. What's beaten down often will have its day in the sun. It's impossible to say when, but it's good. It's healthy for markets to have this rotation. Investing is not shovel money in the 5 biggest tech stocks, print money, and don't worry about anything ever again. So this is healthy. So we did have a correction. Correction, again, is defined by 10% pullback. Again, we get one of those every 2 years on average. This is the S&P median total return after corrections since 1928. So this covers a lot of data, a lot of periods. Once we reach a correction, this dark blue, a year later, on average, markets are up by 16%. And this is all other periods. So what this says, performance tends to be better a year after corrections. And that makes sense. The more pain we have today, chances are future returns are going to be higher. The lower your starting point, future returns tend to be higher. And the opposite is true. The higher your starting point, future returns tend to be lower. So, if you have 20 plus years to invest, a market sell-off is not a bad thing. If you are retired or about to retire, you better have a portfolio that fits your situation. You better have a portfolio where you understand the range of potential outcomes, because when you retire on that day, your assets need to last the longest period of time for most people, right? If you retire at 60, your assets probably need to last for 25 plus years. If you retire at 80, let's say, your assets need to last for 10 years. So the earlier that you retire, the longer your potential life expectancy is, you're in that danger zone where if you took a 30+% pullback or a 20% pullback, that could adversely affect your lifestyle. Because if you're taking money out of your portfolio, it needs to last for the longest period of time. The market tanks, your capital base is impaired, you might not recover from that. So the most important thing that new retirees need to do is make sure they have a process for managing risk. Their portfolio fits their financial plan. You fully understand the range of potential outcomes. You're not anchoring to weird things. You're not market timing, because this stuff matters and things can get weird quickly. We've seen a lot of weird things in the last 2 years. And I think people, one, need to get comfortable with weird things and not be surprised by them. Be comfortable with randomness, because complex systems are random. And two, the time to address all this stuff is today, not after something happens, you go in and make a bunch of changes. So I touched on this earlier. This is a unique period. Stocks and bonds are down together, which doesn't happen very often, which you can see here. So 1978, 2009, 2022. In January and February, these are the only instances where stocks and bonds are down together the first 2 years of any year. And so what we've done here is shown the various returns. So the S&P this year, again, as of this posting, down about 8%. Long bonds, so 30-year bonds, 30-year U.S. Treasury bonds are down about 5%. We don't know what the rest of the year holds or what March holds. But looking back at the last 2 times this happened, the S&P actually did quite well in both instances. Bonds were kind of mixed, positive here, negative here. This sample size is extremely small, no absolute conclusions. This is just interesting, pointing out how rare this is for stocks to act squirrely and bonds not to provide a buffer. So bonds to be negative as well. But again, this trend is starting to reverse a little bit. And for pure clients, at least, we weren't piling into long bonds. So most of our fixed income was relatively flexible, relatively short maturity, which allows us, if rates do move higher, those bonds mature, we reinvest at higher rates, which is good for everybody. If you're a net saver, rates going up is not a bad thing, as long as you're positioned appropriately today. So the silver lining to all this, these tech stocks getting beaten down, is they've suddenly gotten a lot cheaper. So this is the Nasdaq Composite price to sales ratio. The higher this line goes, the more expensive technology stocks are. The lower this line goes, the cheaper technology stocks are. This was the pre-COVID high. These tech stocks are actually cheaper today than they were in November of 2019. So if you're and I'm not saying these are super cheap, but they're cheaper than they were. If you're a tech fan and a bargain hunter, you might sniff around and see what's a good value today. And this is good for context. This always cracks me up when people compare the tech bubble of the early 2000s, where you can see these were just ludicrous. I mean, a lot of these valuations were companies that didn't even make money. They slapped a .com on their company name and skyrocketed. This was the definition of a bubble. People throw around bubble a lot, and I don't like that, but if you use bubble to describe this, you are correct. This shows the air coming out of the bubble, tech stocks, and again, this is price to earnings ratio. Have ticked higher, but you can see there's a little blip. They've come down quite a bit for the Nasdaq Composite Index here. They're still relatively elevated by historical standards, and by that I mean the last 10 years or so. But comparing this to this doesn't make much sense to me, because tech companies are more profitable than they've ever been right now. In fact, they're so profitable that the government wants to slap antitrust suits on them, because they say tech companies are anti-competitive just because they dominate across many different subsectors of the internet. And this is just a look. This is just a deeper look at some of the bigger tech companies, both their size today, what their PE ratio and price to sales ratio, so PE, price to sales, price to earnings, were last fall. So this is pretty recent. So last fall, the higher the number, the more expensive per unit of earnings or per unit of sales. So you can see some of these numbers are pretty high here. And for the most part, across the board, lower valuations on the right. So again, if you like big tech, if you like some of these companies, you can find that they're trading at much cheaper levels today than they were just a few months ago. But something I would caution here, see, some of these numbers are huge still, like these market caps, 1.5 trillion, 1.7 trillion for Google, 2.2 trillion for Apple, or excuse me, Microsoft, 2.6 trillion for Apple. It's going to be really hard for these companies to double in size from here. And I've been saying this forever. Like if you're expecting 30+% a year in Apple stock, you're going to be disappointed. You might enjoy market returns, 8 or 9% a year going forward. That's great. But I think a lot of people need to reset their expectations. Much easier to go from a $2 billion company to a $1 trillion market cap than a $2.6 trillion market cap to a $5 trillion market cap. You're running into the law of large numbers here. The Fed, everybody's favorite topic. So a week and a half ago, you can see this is start of the year, January 1, February 1. This is basically the odds of a 50 basis point hike. So a 0.5% hike in March was basically a certainty, almost 100%. This is percent. Was almost 100% certain a week and a half ago. Now, only a 20% chance of a 50 basis point hike. So this is what I mean when I say taking your cues from the market. Folks, the market is giving us hints every day with the smartest investors voting with their capital. They're moving markets voting with their capital. They're putting their money where their mouth is. Why in the hell would you listen to some guy on TV or some guy selling a newsletter or some guy predicting the end of the world or some person on Twitter when they're just talking nonsense? There's no penalty for being wrong. They can spew whatever they want. That's noise. That's not actionable investment advice. A much better approach would be get an information filter. Take your cues from the market. There's hints everywhere that tells you not what happens next, but a much more rational, realistic, measured, tangible cue that can help you make better investment decisions. So yeah, people are out there saying rates are going to go up, the Fed's going to hike to tackle inflation. This has reset completely overnight. 100% certainty to barely a 20% chance. And I've said this before. People act like the Fed is making monetary policy and they're just forging ahead with their agenda. They're very much a follower. Market conditions change, the Fed's going to change. There's no better example than this right here. Again, a lot of talk about bond yields blowing out. You're looking at, this is the 10-year U.S. Treasury. We're basically back to where we were pre-COVID sell-off. COVID hit, everyone got nervous, flooded into U.S. Treasury bonds. Yields have slowly ticked higher. Now we're back to where we were 2 years ago. So there's been a lot of talk about rates moving higher, even as far back. I mean, look where rates were in March of 21. I mean, we're not that much higher from March 21 levels. And after today, this has dropped more like down to here. So there's just a lot of noise about rates going higher. And when you actually look at, again, the cue that the market is giving you, I mean, this is a big yawn. Like if you were to stack this up with what people are saying about interest rates and bond yields, I mean, they're telling two different stories. So again, take your cues from the markets. Same thing with the 2-year note. I mean, look at this. This looks like a big bathtub. Rates fall because of COVID. They kind of clunk around near zero. They rise back up. But going back 2 years, they're basically the same. And again, this is in response to the Fed. So the Fed can control this by raising short-term rates. That's what this is pricing in. The Fed can't control this, which is why this is a little more clumsy. This is like a random walk here. This is much more intentional from the Fed. You can kind of set your watch to this, not so much this. Now, mortgage rates, a lot of hot mortgage rate ticks, and this has ticked up higher. So as the US 10-year creeps higher, that does show up in the 30-year mortgage rate, which they are much higher than they were at the low here in July of 21. So 3% up to 4.3%. So this might have an impact on home prices. If the cost of borrowing goes up, most homes are a heavily levered asset, meaning most people borrow a lot of money to buy houses, and home prices are up. So this is something to watch here if this ticks meaningfully higher, but I honestly just don't see it, to be honest. And then looking at a historical look since 1998, rates are still historically low. This orange is days where over the last 25 years, mortgage rates were lower than they are now. So if you go back over the last 25 years, yeah, there's been a few instances where rates have been lower than where they're at now, but there's been much more time or instance where rates have been higher, and that's the light blue line. So historically, interest rates are still low. That's pretty much it. I tried to keep this one a little shorter. I don't know where we're at, 30 minutes. I'll quit talking just to give you a sense of some of the things that we're looking at. I hope this helped. I hope I didn't talk too fast or wasn't too confusing. If you have any feedback, if you have any questions, if you want to hear more about a particular topic, feel free to let me know. I hope you enjoyed this. Thank you and happy investing.